As Warren Buffett famously observed, more money has been stolen with the point of a pen than at the point of a gun. For decades, checking a company's financial health meant reading dense, black and white ledgers. You had rows of raw data, a few notes from the accountants, and very little room for PR to spin a story. Today, annual reports look like lifestyle magazines. They feature smiling executives, interactive charts, and massive sections dedicated solely to brand building and corporate narratives. This influx of information creates an illusion of transparency. When a company hands you 300 pages of glossy graphics, your brain assumes they have nothing to hide. But burying a severe financial threat in a mountain of interactive data is far easier than hiding it on a single sheet of paper. Taking these documents at face value is how capital gets wiped out. To spot anomalies before they trigger a collapse, you have to practice forensic analysis, the art of finding the truth when management is actively trying to distract you. In forensic accounting, a red flag doesn't necessarily mean outright fraud. It is an early warning system. It tells you to check your pockets because there might be a hole you haven't noticed yet. This diagram shows a stylized income statement, the first place we look during an investigation. Forensic analysts scan here for manipulated revenue recognition, like booking sales before cash actually changes hands, or aggressively padded net earnings. Next, we move to the balance sheet. Companies can distort their financial reality by stretching out depreciation schedules to artificially boost today's profits, or by keeping specific liabilities entirely off the main books. Finally, we check the shadows. We map out related party transactions, tracking money moving between the company and outside entities controlled by the management team's friends or family members. Finding these warning signs requires reading past the provided numbers. You are looking for the strategic omissions, the specific data points the company deliberately chose to leave out. To see this in practice, let's look at the Indian stock market. Regulators here have a reputation for biting first and asking questions later when they spot a discrepancy. Consider Rajesh Exports, a massive gold retailer. In late 2023, they submitted their initial financial filings for the second quarter. There was a glaring problem with the paperwork. The company completely left out their cash flow statement. An untrained investor might assume an intern simply forgot to attach a PDF. A forensic analyst sees a company refusing to show exactly how much actual cash is moving through their accounts. This chart shows a timeline of the company's subsequent disclosures. On November 8th, they gave the exchange a standard update on their business operations. But weeks later, on December 17th, they admitted they had been hit with a serious order from the income tax authorities. The documents revealed they actually received that tax order back on November 8th. The routine operational update was a distraction, dropped on the exact same day to keep investors looking the other way. If the tax issue was a minor misunderstanding, they would have disclosed it immediately. Delaying that information for over a month forces you to ask what else the management team is trying to buy time for. Once the timeline manipulation became public, the market reacted. The delayed tax disclosure validated the exact fears raised by the missing cash flow statement. Trust evaporated. Major financial institutions, including the investment firm Ambit, completely pulled their coverage of Rajesh Exports, citing the financial impact of the tax matter and the severe corporate governance lapses. Rajesh Exports is just one example, but the mechanics of this cover-up apply everywhere. Companies across all sectors use these exact tactics to obscure bad news. When executives face a crisis, self-preservation takes priority. They will use every tool at their disposal, from omitting vital documents to aggressively timing their PR releases, to protect their positions and keep the stock price elevated. To protect yourself, you have to read the footnotes. You have to question the delayed filings and notice the missing pages. By the time a company finally admits there is a problem, it is already too late to escape the damage.